Watch out in United Toys for the following items. That is quite different from what you had before. There was an increase in the allowance for credit losses. So have a look how you should treat that. And then obviously that's got to do something with debtors, and that's got something to do with cash received from customers. Then also watch out, here's the inventory movement. There was a write down in inventory, so that you see how to treat that. Look at the interest paid, cum interest payable, cum interest expense. That is important in this question. And then it's also worth your while to look at the tax, the amount that we pay to receive of revenue. There was also a small catch in this question what that is concerned. So United Toys is a fast-growing company, manufactures toys, and then the year end is 31 December 2016. They give you an extract of the line items in the statement of profit or loss for the year ended 31 December 2016. 2016-2015, revenue, other income, interest expense, dividend income, and then profit before tax. Then they give you a statement of financial position as of 31 December 2016. Non-current assets, PPE, fixed deposits. Don't forget that one. Current assets, inventory, trade, and other receivables, cash and cash equivalents. Then on the equity and reserve side, share capital, reserves, revaluation, surplus. Look there, that's the first time that we have something like that. So obviously we had some land or something that was depreciated. Retained earnings. Non-current liabilities, interest-bearing loan. Current liabilities, bank overdraft, current portion of interest-bearing loan, trade and other payables, and then total equity and liabilities. Then they give you the additional information, and let's just have a look at the required part. Present the cash flow from operating activity section and the cash flow from investing activity section in the statement of cash flow. So not the full cash flow, only those two sections, which is in any case about 80% of the cash flow statement, and we have to apply the direct method. Now what I didn't tell you in this question, and the answer doesn't have it, ignore comparative figures, VAT, notes. I didn't prepare the notes and VAT. Okay. So let's start then there with our PPE figures. We know that the direct method starts with cash received from customers, guys, but you know what? I love to start with PPE because it gives me so much information. So I'm going to start with PPE. PPE, they have the line item in the statement of financial position. Additional information. Land is not depreciated, but buildings are depreciated at 2% per annum on the straight line basis. Then in determining the operating profit, now you will see that we have operating profit here. We only have other income there. Amongst others, other things were taken into account: depreciation machinery, depreciation buildings, auditors' remuneration and directors' remunerations. Yes, other income. There's a line item, other income, as per the information provided to you, which was that 12,000 rand there. 12,000 rand other income. Let's just write it here. Total there was 12,000 rand other income. They say that comprises of the following: profit on the sale of a portion of land with a cost price of 20,000. Now remember, land is not depreciated, which was sold for 35,000 rand. Land was replaced during the course of the year. So guys, what was the profit on the sale? Profit on the sale was then 35,000 proceeds less 20,000, which gives us then 15,000 rand. Sorry. Then also included there was a profit on the sale of machinery of 5,000 rand. Then also included there loss on arising from the damage to the inventory. So there was an inventory loss caused by flooding during the cloudburst. Other income. Now, if I had a loss, and it's in any case incorrect according to IS1 to classify it like this, but this is the way that I gave you the information. So we are not here now to do the IS1 criticism. We are here to do the cash flow statement. So all we have to do is to use whatever we have up till now. So there we had a profit of 5,000 Rand. We had a profit of 15,000 Rand. So we have a total profit there, which is the income figure, and we talk about other income, of 20,000 Rand. Now, what was the amount that they gave us in the income statement? The amount that they gave us in the income statement was 12,000 Rand. There it is, 12,000 Rand. So what was the inventory loss then? That must have been the difference. So the inventory loss was the 20,000 less the 12,000, which gives us 8,000. Okay. Then trade and other payables were made up as follows. Trade creditors, sales income tax, interest payable. Oh, mark that one, that you don't forget that one, because now there will be a difference between the interest expense and the interest actually paid. And you are going to use both of them. Interest expense, you have to adjust your profit before tax figure with. But when we're actually going to disclose separately interest paid, it's going to be the actual cash flow that took place, and then shareholders for dividends. Land was revalued on 31 December. Now, if we look here at your equity section, there we've already identified that there was a revaluation surplus of 35,000 Rand. Dividends declared for the year amounted to 28,200. Income tax for the year was calculated at 28%. Included in trade and other receivables were the deduction of the allowance for credit losses of 5,000 in the 2016 year and 3,700 for the 2015 year. During 2016, machinery with a cost price of 10,000 and accumulated depreciation of 6,050 Rand at the date of sale was disposed of. And then they give us a breakdown of our non-current assets. So let's start with land and buildings. Draw your T accounts in your cost account. For the first time, we're going to have an accumulated depreciation. You can see that clearly there was nothing there. 1050 for the current year. And then here somewhere, they also told us that our depreciation charge for the year was 1050. Right. Let's start here. Land and buildings. Opening balance, 48,500 Rand. Okay. Closing balance, 83,500 Rand. We have revalued our land with that 35,000 Rand, which we've picked up from our revaluation surplus account. 35,000 Rand. Then they told us that somewhere during the year, profit on the sale of a portion of land with a cost price of 20,000, so there was no accumulated depreciation, and it was sold for 35,000 Rand. So in our realization account, we would have taken out the 20,000 out of the cost price account, dump it into the realization account, proceeds would have been 35,000. So therefore, we would have accounted for this profit of 15,000. This is not really necessary. If you just show me your calculations as you're going to use something, then it was not necessary to draw the T account. Because if you have the T account, it's so nice and clean and everything is together. And you don't have to squirrel around to get your answers. So we have to do the investing activities. that one will go to investing activities. Once we are actually balancing off our land and buildings account, we will see that there was a debit entry missing on the debit side, and that must have been new land acquired for the year. And they tell us here land was replaced during the year. So there we already worked out the profit of 15,000. So in our section of cash flow from investing activities, let's go and dump the information that we already have. Proceeds on the sale of land, the cash inflow of 35,000 rand. Additions to land and buildings, they tell us then it is replacement. Don't you go and write expansion if it was replacement. Replacement, 20,000 rand in brackets. And that was the balancing figure which we have worked out here. Now our accumulated depreciation the balance was 0. Our closing balance for accumulated depreciation was here 1050, and they also told us that our depreciation charge for the year was 1050, so we have that. Moving to machinery at cost price, you're going to open up your cost account, opening balance 150,000, closing balance 215,000. Okay. Your accumulated depreciation account, opening balance 48,500, closing balance 62,450. There you have that. They gave me my depreciation on machinery for the year somewhere. I think here. Depreciation. Oh, they didn't. There's a question mark. Okay. Profit on the sale of machinery was 5,000 rand. During 2016, machinery with a cost price of 10,000 and accumulated depreciation of 6,050 rand at the date of sale was disposed of. So we're going to take out the 10,000, drop it down to the asset disposal account. We're going to take out the 6,050. We're going to drop that down to the disposal account. We're going to account for the profit which they gave us on the side of the machinery of 5,000 rand. So therefore we can work out what the proceeds was, and the proceeds was 8,950 rand by balancing off this account. Once we have the proceeds, we can go and dump it where it should be. Proceeds on the sale of machinery, 8,950 rand. Now we can balance off our cost price account, and on the debit side, we are actually needing a debit of 75,000 rand, and that was new machinery purchased during the year. So once we have that figure, we can dump it where we should. Additions to machinery, replacement, 75,000 rand. Then in our accumulated depreciation account, when we're actually going to balance this account off, then we need a credit entry to make this account balance, and that is representative of your depreciation charge for the year. So there's the 20,000 depreciation charge for the year, which we are going to use right now as a non-cash flow item. Great stuff. Then we've done everything regarding PPE. So let's now start with cash received from customers. They gave us the revenue figure for the year. So the revenue figure for the year equals 350,000 rand. We have to adjust it then with a movement in debtors. Here we have trade and other receivables. Last year 43,000, this year 54,200. But they tell us included in trade and other receivables was the deduction of the allowance for credit losses of 5,000 rand for the 2016 year and 3,700 rand for the 2015 year. So the balance of trade and other receivables, as they gave it to us, was not a gross figure. It was not a figure according to the debtors control account. That was after we have deducted this allowance for settlement discount. So if we want to work out the movement in debtors, What we will have to do is to adjust our opening balance and adjust our closing balance first in order to derive at the actual movement in balances. So, we are going to add back the allowance for credit losses. Last year it was 3,700 Rand, this year it was 5,000 Rand, and the actual amount for trade and other receivables was 43,000 and 54,200. So 43,000 last year's balance plus last year's allowance plus this year's balance and this year's allowance is going to bring us back to our gross figure for debtors. And now we're going to calculate what was the movement. There was an increase of 12,500 Rand. So that is the amount that we have to account for against our revenue figure. It was an increase in debtors, so therefore an outflow of cash. So our net cash inflow from customers equals 337,500, and we go and dump it where we should, 337,500. Cash paid to suppliers and employees, that's our next calculation. And where does this calculation start? This calculation starts with my profit before tax. Profit before tax equals 120,000 Rand. Now remember, cash paid to employees and suppliers is all about expenses. So the first thing that was included in that profit figure was my revenue, which I have to take out. It's got nothing to do with expenses, and I've in any case already used my revenue figure. So I'm going to take out my revenue of 350,000. Then I have to adjust my profit before tax for non-cash flow items. Now here we have a few. We have profit on the sale of land of 15,000. We have profit on the sale of machinery of 5,000. We have depreciation on land of 1,050, and we have depreciation on machinery and equipment of 20,000. So there's our profit, depreciation. Going back to your question, we have just dealt with trade and other receivables. And we've seen that in trade and other receivables, there was an allowance for credit losses. And we saw that that allowance for credit losses has actually increased from 3,700 Rand in the 2015 year to 5,000 Rand in this year. So clearly there was a movement. The movement that took place was obviously 1,300 Rand. So what did I do? I debited an expense account, whether it be credit losses or credit losses adjustment account, and I credited my allowance for credit losses. So it went through the income statement, and because it went through the income statement, it had an impact on my profit before tax. A non-cash flow item, it was an expense, so I'm going to add it back. Add back, increase on the allowance for credit losses of 1,300 Rand. Another item which was a non-cash flow item is this loss arising from the damage to the inventory. We've written off inventory, so we credited inventory, we debited an inventory loss account. The amount of that loss we've already worked out was 8,000 Rand. So for that inventory loss, which was included in other income for some or other funny reason that I don't understand, that 8,000 Rand was also a non-cash flow item which I have to adjust my profit before tax with. So here, loss on the inventory, 8,000 was an expense, so it decreased my profit before tax. So if I want to eliminate that, I have to add it back. Great. Then I have to adjust profit before tax for separately disclosable items. Now I can only adjust profits with amounts that was accounted for against profits. So if we go to our income statement, we had an interest expense. That obviously affected my profit before tax. So that interest expense, which was accounted for against 120,000, was 900 Rand. So I'm going to add back the 900 Rand. Now you're going to say, you made a mistake, because remember, there was interest payable somewhere. Interest payable. Guys, yeah, but the interest payable was not in the income statement. What was in the income statement? the interest expense that was in the income statement. So therefore, I can only add back the 900 because only the 900 was included in the 120,000. Another separately disclosable item is my dividend income of 3,000. It increased my profits before tax, so if I want to eliminate that, I have to take it out. I have to minus it against my profit. Then adjusted for working capital changes. Now the first one is the movement in inventory. Inventory actually increased from 30,000 to 50,000. But is that 100% correct? Well, technically speaking, it is correct, but the 50,000 was the final inventory figure after I have adjusted my inventory with a write-down of 8,000 Rand. Now, that 8,000 Rand cannot have an impact on my cash flow. So therefore, I'm going to readjust my figure there to what it would have been before the write-down took place. And that I'm going to compare with last year's figure because that will really represent the actual increase, the actual purchases of inventory items during the year. So that movement in inventory is going to be increase in inventory 50,000 plus the 8,000. Very important. Plus the 8,000 less last year's figure of 30,000. That is going to give me a cash outflow of 28,000 Rand. There's no such prepaid expenses or accrued expenses or something like that. The next one is trade and other payables, and there was an increase of 5,000 Rand in trade and other payables. Why is this different? Oh, yeah, now I've made the classical mistake that you could have made, probably would have made, because here they give me the breakdown of trade and other payables. So you cannot use the amounts just given there because look what is included in that 25,000 Rand. So it's all only about the increase in trade creditors. So the 17,100 less the 8,500, which then gives us an increase of 8,600, which is a cash inflow. So once we actually add all this up, it will give us our cash paid to suppliers and employees of 241,150. If you had to do the reconciliation note, let's see what the reconciliation note would have looked like. You would have started exactly here, profit before tax. What you wouldn't have done is you wouldn't have taken out revenue, so this line item would not have appeared there. So that one would not have been there. Got to do that. And then here, with my working capital changes, you would have added here the movement in trade debtors. So that movement of 12,500 Rand would have been added here under the working capital changes. And that would have given you your cash generated from operations. That one there, 96,350. So you can go and do that and see whether you're going to derive with that figure. You should, otherwise you've made an adding error somewhere. Great stuff. Dividends received. They don't give us any further information except the dividend income figure in the income statement. So therefore we can use that as actual cash flow. Dividends received 3,000. Now we get to interest paid. Now remember that there was interest payable in our little trade and payables note, which I have not paid attention to. Where is it now? Yeah. Interest payable at the end of last year. So our opening balance 1,500, our closing balance 900 Rand. Interest payable, opening balance 1,500, closing balance 900 Rand. How much did we account for in our income statement? We have accounted for interest expense of 900 Rand in our income statement. So we would have debited interest expense, credit interest payable. So there's our interest expense, 900 Rand. If we now actually going to balance off this account, you see that we have only paid interest of 1,500 Rand for the current year. So now as a separately disclosable item, it is under that line. So here it is all about interest actually paid. Interest actually paid, which is 1,500 Rand. Dividends paid, they gave us that figure in the question. They said we had shareholders for dividends in the beginning of the year, 4,000 Rand. We had shareholders for dividends at the end of the year of 2,000 Rand. And then they also told us that the amount of dividends declared for the year was 28,200 Rand. So similarly, like the interest, we're going to restructure that shareholders for dividends account. Opening balance 4,000, closing balance 2,000, dividends declared 28,200. So that then means that our balancing figure, 30,200, would have been actual dividends paid for the year. Look at income tax. Now, in the question, they gave us our profit before tax, 120,000. They also tell us that income tax for the year was calculated at 28% of profit before tax. It's also 28% of profit before tax. Now, I actually should have added it in here. No, they should actually not. Of taxable income, that is what I should have said. Taxable income. Now it's right. Okay. Now that 28% of taxable income will mean that you have to calculate taxable income because it is not equal to profit before taxation. You're going to start with your profit before taxation, but dividend income is not subject to normal tax. So therefore, once you do that, you going to say our taxable income is going to be the 120,000 less the 3,000, and that is going to be what? 117,000 is taxable income. That multiplied by 28% gives us 32,760, and that is my expense in the income statement, 32,760. And now when you balance off your income tax account, you'll see that we actually paid SARS 33,760 Rand for the year. We can now add all this stuff together, and that will give us cash generated from operating activities, 33,890. Let's quickly just complete our cash generated from investing activities. Remember, we've cut it in our fixed deposits. There was also an increase in fixed deposits of 6,000 Rand. Increase in investments, 6,000 Rand. Outflow of cash, the rest we've already completed, so we can just add it, and that gives us total cash generated. It's an outflow of 57,050. And that's it.